This one stock that I believe that is truly worth buying is Kirkland. Right now, the company's PE ratio sits at 12.77. This is normally seen as acceptable, and the PB ratio sits at 1.99, and this is also seen as acceptable. One more acceptable factor with this company is that its beta is sitting at 0.67, and therefore the investors or this company are not too volatile. The information and the news do not necessarily affect the investors of this company. Therefore, the investors are not too trigger happy or sticky hands. Looking at the year range of this company in the last 52 weeks, the highest valuation or stock price that this company traded for sits at 55.29, and the lowest is 31.72. With its current stock price being at 39.46, it seems that it is at least in the lower end almost in the last 52 weeks. The forward dividend yield of the company is forecasted at 1.89. So the forward dividend yield is the forecast of the analysts on how much would be the future dividend yield of this company. Again, right now, the dividend yield of the company sits at 1.74%. Therefore, the analysts of this company are positive on the growth of the dividend yield of this company. There are a variety of factors that are competitive and sustainable with Kirkland. For one, it has a high and durable moat. Moat is a business's ability to maintain competitive advantages over its competitors in order to protect its long-term profits and market share from competing firms. Think of a castle that is surrounded by water, thereby making it hard for invaders to penetrate the walls. This is also applicable in economic and business terms, in a way that the business is not easy to replicate, thereby making profitability high and competition low. Exploration, mining, and mineral processing are incredibly complex things to do well. So with Kirkland, its moat is high and durable, hence the entry of competition is not necessarily a threat. The mining assets of Kirkland sit in Canada and in Australia, which I would say is a double-edged sword in a way that it is positive because both these countries are politically and economically stable. Therefore, revolution or political turmoil are not necessarily a threat. On the other hand, it could also be a negative factor as well because the company lacks diversity on its resources, on its mining assets. Nevertheless, let's dive deep into this company. Here in their statements, there are factors driving outperformance, growing low-cost production, and in a while we will see if this is indeed happening, the industry's leading earnings per share and cash flow, exploration success and reserve growth, increasing quarterly dividend, and I will show you in a while as well if this is true, and repurchasing shares. One interesting factor with this, guys, is that there is no debt with the company, and therefore the company is not overburdened with any debt or liabilities that it has to pay. This therefore makes the company even better and more sustainable and durable when it comes to operations and growing the company further. This is the cash flow statement of Kirkland, and as you see here, since 2016, they have certainly increased their net income from 2016 to 2017. They tripled their net income, almost double in 2018, and fast forward to 2020, they achieved 140% net income compared to 2019. There is no question these guys do work, but more than that, I want you to look at their cash flow from operating activities here and see how much bigger their cash flow from operations as compared to the net income, and this is a sign of a healthy company. The earnings per share of the company are also recorded on increasing and growing territories. Here is the history from 2016 until 2020. This is the timeline of the earnings per share growth of the company from 2010 until the trailing 12 months, and these are all in US dollars. If you will find here, in 2010, they were on negative territory and there was a little bit of choppiness until 2014. But from 2015 until the trailing 12 months, they have been growing their earnings per share. And if you want to have an idea on the percentage growth, here in 2015, they grew at 156% from negative territory in 2014. And right now, they're just growing 634%, 214%, 106%, and in 2020, they have grown at 40.6%. Now, yes, there is growth here on their earnings per share, but one thing that I want you to also realize is that if you notice, the growth, the percentage growth is depleting as well. It's going lower and lower each year. So in 2015, it was recorded at 156%. 2016 was 5-6 times. But then come 2017, it grew to 214%, and then lower in 2018, lower in 2019, and in 2020 year ended, it recorded only about 2 decimal figure really here at 40.6%. So I guess this is one thing or factor that you have to consider and watch out for the EPS growth rate. Nevertheless, the EPS does grow. The value itself per share, the earnings per share, they do grow. Another important factor here is the return on equity and the return on invested capital. If you had been listening or watching some of my videos in the past, you will notice that I always look at the return on equity and return on invested capital. So this shows essentially how successful the company is in employing its assets and its equities or its cash when it comes to investing. So in this figure here for ROE and ROIC, I am certainly happy if I see between 15 and 20% growth rate. But here, looking from 2010, from minus 8.4% until 2015, they grew that. They got out of the negative territory and then just grew this wolf from 2.5% to 2018 at 21%, and right now sitting at 30%. In 2020, they are sitting at 15.5%, and a trailing 12 months is a growth so far as compared to 2020. And this is the same figures as the ROIC, mainly because the company does not have any debt, and therefore these two figures are the same and aligned. This is the historical dividend payouts of the company since 2017 until 2020. They only provided dividend payouts from 2017, and therefore from 2017 their annual dividend was 0.03 a share, and they grew that tremendously until 2020. So in 2020 they increased their dividends by 227.4% as compared to 2019, and in 2020 they have so far increased their dividend at 50%. So this is only until the first half of the year. We have to wait until the second half of the year to finish in order for us to have a better understanding on how much exactly is the dividend payout of this company for year ended 2021. Now, with regards to the payout ratio, the company pays out 22.1% of its earnings to its shareholders as dividends, and this is a very healthy number. The 3-year growth rate of the company on dividends is 98.8%, and this is also a truly acceptable figure. Now, I made a whole video about the concept of earnings per share, the payout ratio, as well as the other factors you have to consider on dividend investing. If you want to know more about it, I will link that video in the description below. I believe that if you watch that video, you will have a better understanding on how important the earnings per share, the payout ratio, and the dividend growth, and not just the yield, but the growth itself in valuating dividend paying stocks before deciding on making such investments. One of the company's statements in its report is that it has growing low-cost production, thereby one of the factors that drives the company's outperformance. Now, let us have a look on the income statement of this company and compare the revenue to the cost of goods sold. If the revenue is growing and the cost of goods sold is growing at a smaller or lower pace. In this figure here from 2016, it says 403.34, and that means it is in millions. Now, let's do that. 403.34, and this is how you read it. So then 403.34 times 1 million, because it says here it is in millions of US dollars, and therefore how you read this figure here is 403,340,000, and this is the same process that you will do with the rest of these figures here. So then this figure here in 2020 is actually 2,460,104,000. So going back in 2016, they recorded 403 million, and the cost of goods sold is 192.84. If you look in 2017 and make a comparison, in 2017, the company grew their revenue by 185%. They actually almost doubled that. But then if you look at the cost of goods sold, they grew the cost of goods sold or their expense at 150%. Therefore, the growth of the revenue is much higher than the growth of the cost of goods sold. Now, let's look at 2018 here. The revenue increased as well, but the cost of goods sold actually depleted. It decreased. They had more revenue, but then they used less or they spent less than in 2017. Now, let's fast forward to 2020. The revenue of the company in 2020 grew 6 times higher than in 2016, but the cost of goods sold was actually grown, or the cost of goods sold grew 3 times only as compared to the cost of goods in 2016. Therefore, in this figure here, we can certainly make a conclusion here that the revenue of the company grows 3 to 4 times faster than the cost of goods sold, or the expense that the company pays or spends in order to create this revenue here. And this is absolutely a good thing. This is a good factor. Therefore, the company is managing its expenses properly. In 2019, the company recorded to have purchased more than 1 million shares, and in 2020 they again repurchased more than 18 million shares. That is worth 732,000 US dollars. Could you imagine the difference between the 2019 and the 2020 repurchasing of this company? This is only 1 million, and this is about 18, 19 times higher than in 2019. So therefore, the company's assets or cash essentially is used to even further increase the value of each share, thereby creating more equity or ownership for the shareholders. When you are evaluating a mining company or even an oil and gas company, one of the most important factors that you always have to look at is the future reserve of the company, mainly because the future production and operations of these companies definitely rely heavily on the future reserve and production life of this company. Even with a company that is well and best managed in the world, without any reserve in the future and production life, that company will have to go down. And here, with regards to the company's technical report, predominantly about the highlights on the 2021 Life of Mine Plan or LOMP of Kirkland, wherein they mentioned they have got a production of reaching 900,000 ounces in 2032. So that's 10 years into the future. The company is well reserved 10 years into the future. They have also mentioned that they do have low unit costs or low production costs on their operations, as well as mineral reserve that will provide them production life of 22 years into the future. They do plan to further grow this production life, of course, in order to further increase the profitability of the company. And here in 2021, by this year, they will announce a new LOMP or Life of Mine Plan, wherein they will release exploration results of the company. In conclusion, Kirkland Lake Gold had been recording phenomenal numbers. It has been recording growth on its earnings per share. The return on equity and return on invested capital have grown from negative territory, as we have seen, to positive, absolute remarkable positive territories between 20 and 30%. They have grown it, and those two factors, ROE and ROIC, are absolutely important to look at. The payout ratio of the company is 22%, thereby making 78% of the company's earnings retained by the company to further invest and grow the operations and revenue of the company. And talking about the revenue grew 6 times as compared to 2016, but then the cost of goods sold only grew 3 times as compared to 2016, and those are absolutely phenomenal numbers. They have been managing their expenses very, very well. Now, as I mentioned already during the first parts of this video, the only concern that I have is the declining growth on the earnings per share. That is one. And then the second one really is that the company had been missing some of its earnings targets in the last 10 quarters. Nevertheless, they have shown and recorded growth in their earnings. At 49.68%, I believe that this company is undervalued and certainly worth looking at. If you believe that this company is also worth looking at, I suggest and certainly recommend to you to look at this company deeper. Do not invest, do not buy the stock of this company just because you watched one video. Thank you very much indeed for watching this video. I hope that you gained value in this video and in my channel as a whole. And if you did gain value in this video, please like, share, and subscribe. And I will certainly see you, hopefully, in my next video. Thank you very much.